In this video, we're going to look at the open interest. It's a number that option traders tend to look at a lot when they're placing trades, and in this video, we're going to see what is the open interest, what it represents, and how you can use it at your advantage so you can place better trades. And hopefully at the end of this video, you'll have understood the advantages of using the open interest when placing trades so you can make better decisions in the future. And if you enjoyed that video and want to see more videos around options and how to trade them, make sure you subscribe down below and like this video. That'd be the best support and I really appreciate it. But first of all, what is the open interest? And the open interest is the number of outstanding derivative contracts that are right now in the market active and that haven't been settled yet. And what's important to mention here is that the open interest gives a picture of the option activity for a certain underlying at a certain strike. And so you fully understand what the open interest means. Let's imagine that we have someone who wants to buy an option and someone who wants to sell an option. If those two actually buy to open a position and the seller sells to open a position, the open interest will increase by 1. However, if they both close their positions, then the open interest will decrease by 1. And in the last case, if the buyer or the seller transferred their position to another buyer or seller, the open interest will remain unchanged. And it's important to mention the differentiation between the open interest and the volume, because compared to the volume that counts every single transaction and also the ones to close, well, the open interest only counts the number of contracts that are being active right now and that haven't been settled yet, meaning that if a buyer or a seller wants to close his position, the open interest will decrease by 1, compared to the volume that even if someone wants to close the position, the volume will increase by 1 because it counts the number of transactions. And another very important difference between the open interest and the volume is that the volume only counts number of transactions for the given trading day, meaning that if you look at the volume right now and you see a certain number, well, that number only represents what happened during that trading day, compared to the open interest, which represents the number of contracts that are being held right now, regardless of which day it is. It counts the total number of outstanding derivative contracts that are being held right now that haven't been settled yet. Now that you understand what is the open interest and what are the differences between the open interest and the volume, let's see what is the meaning of the open interest and how you should interpret it in your own trading. And when you think about it, if the open interest represents the number of contracts that are being held right now, well, it pretty much means that we are measuring the liquidity of a certain strike for a certain underlying. And personally, the open interest is something that I use all the time. Whenever I want to enter a position, for example, let's say I want to open a strangle on Facebook, I will always look at the different strikes, and what I end up doing myself, for example, taking back that example of the short strangle on Facebook, and I want to open a 5 delta strangle. If I see, for example, that the 4 delta or the 6 delta has a lot more open interest than the strike that I had originally chosen, I will definitely go for the strike above of the strike down, which has a lot more open interest. That reassures me in a way that I will have less struggle to enter the position, and I will also have a lot less struggle to get out of the position. Because in the end, it all comes down to how easily it's going to be for you to get in a position and get out of a position. If you struggle to get out of a position and you have to give back all of the profits that you hardly earn with that position, well, it's going to be quite annoying for you. So it's way better to choose a strike where you have a lot of more open interest rather than a low open interest, because on the long term and when you're going to try to get out of the position, it's going to be a lot easier for you to get out if you have a lot of open interest and you had chosen that strike for that particular reason. And that's something that happened to me when I was starting out trading options. I had absolutely no interest in the open interest without an open intended. And what happened to me once is that I was trading the XLE and I had opened a strangle on XLE, and my strikes that I had chosen had almost no open interest. What happened is that I almost reached my 50% profit mark and I wanted to get out of my position. I wanted to buy back my short strangle. And what happened after that is that no one was willing to buy back my strangle at the price that I wanted to, and I had to give back a lot of my profits so as to be able to get out, and I had to bring back my mid price towards the net price in order to be able to get out. So you can see how annoying it can become if you struggle to get out and you have to give back the profits that you earn in your position. And you'll probably wonder, okay, so what underlyings have a lot of open interest in general, and what are the ones that have very low open interest? Well, to find underlyings that have a lot of liquidity and that have a lot of open interest, you really have to think in terms of what is widely famous and what is not. And it really comes down to this because, for example, if you compare a stock like Facebook and a stock like NIO, you're going to see that there is a lot more open interest on Facebook compared to NIO. And same thing, for example, for the ETFs. If you look at the S&P 500 ETF, the SPY, and you look at another ETF, for example, XLV, well, you will see that the XLV has a lot less open interest than the SPY. SPY. And that's how it is, and I personally stick to very liquid underlyings, and liquidity is something that you should really focus on. And after that, there is nothing wrong with trading something that has low open interest. You just have to be aware that if you trade something that has very low open interest, only a few contracts that are being held right now, you might have a lot of trouble to get out of a position. And that's something that every trader should be aware, so they make better and informed decisions when they want to open a trade. It's way better to choose a strike that has a lot more open interest so you can be able to go out whenever you want to, rather than choosing a strike that might be a bit more profitable for you, but you'll have to give back your profits after that because the strike has almost no open interest. And you might wonder, okay, cool, so I know which underlyings are liquid, but if you had to say, for example, a number of open interest that we should follow, I'd say around 1,000 open interest. If you have 1,000 contracts that are being held right now for a certain strike, for a certain underlying, you know that it's going to be liquid. And if you look at, for example, the SPY, you'll see that almost all the strikes have a lot of open interest, way above 1,000. That's why it makes the SPY the most liquid ETF out there. I hope that it made sense and now you understand a bit more the open interest and how it works and how you can use it at your advantage. And if you've got any question regarding the open interest, please make sure you comment them down below and we'll definitely answer any question that you have. Thank you so much for having watched the video until the end, and I'll see you in the next video, and in the meantime I wish you all the best. See you.